Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management. Welcome to our weekly market update. I hope that everyone's had an absolutely fantastic week. It's nice to see we've had a decent and healthy rebound since the last time we spoke. And what we want to do this week is really kind of touch on not just the factors that led to the sell-off over the last month, but what were some of the reasons why we've seen a pretty sharp rebound this week? And then most importantly, is this the start of a trend, ideally, in terms of rising asset prices within energy, the banks, industrials, a lot of those cyclical sectors, or is this a blip? And so we're going to go over the importance of growth. And when I say the importance of growth, I mean the importance of growth expectations and how that impacts interest rates, which impacts asset prices. So we're going to go through all of that today. And of course, we do want to do a update on COVID and where we're at in terms of the overall case count. So the bottom line for this week is that we're seeing increased signs of a COVID peak. We'll go through the charts, but state by state, we're seeing more and more states seeing a plateau, not just in case count, but the rate of change of new cases has started to drop across those states. That's usually the second derivative sign that things are really starting to enter into a COVID case slowdown, which is what we want to see. That's really, really important. That's the one type of slowdown we want to see. Second, improved growth expectations over the last week as a result of COVID, as a result of low unemployment claims, has really served to benefit oil, bank, and industrial stocks. Big reason why we saw a 6% rebound in 3 days. Now, had a little bit of we had about a one and change pullback today, but that was more or less related to investors kind of squaring positions away ahead of tomorrow's Federal Reserve meeting in the virtual Jackson Hole, as we call it. And then lastly, we're going to continue our company spotlight. This week, we're going to focus on Bank of America and ELG Resources. So let's go ahead and get started. Now, in terms of COVID, what we see across the board, whether it's California, Nevada, Florida, Maine, Missouri, a lot of the early states, we're starting to see those cases plateau. More importantly, we're seeing the rate of change go negative in terms of new case count. So we started off with 2 or 3 states like we discussed last week. Now we're at 9 states. As a result, you did see a rebound in a lot of those economically sensitive sectors. And that's important because one of our core theses behind the weakness of the overall portfolio over the last 6 to 8 weeks has been COVID. And this kind of proves that that hypothesis that it really is COVID driving these asset prices, growth expectations, 10-year interest rates, stock allocation underneath the index. This is important. We want to make sure that this continues. Second, just as cases are rolling over, what we've noticed is that the market, in terms of investors, the level of bearish sentiment is at some of its highest levels in the last 2 or 3 years. So that's important because investors are entering into a potential growth recovery or growth expectations recovery, just as they're squaring their positions away to be more bearish, raise cash. And that usually leads to a rise in asset prices versus a fall in asset prices. So this is important. We want to pay attention to this. And that's just after a 2.5% sell-off. Why is it that people will be so bearish after a 2.5% sell-off? Well, just look at our portfolio. The average stock since the beginning of April is down anywhere from 10 to 20% across every sector. The reason why you're not seeing it at the index level, because the index is heavily concentrated amongst 10 companies. And we're going to go through that here in a second. Now, painting the long-term picture, really what we do is we invest in long-term cycles. So for the last decade, we've been significantly overweight technology. Last year, we were about 60% technology. What we noticed is that trend was breaking. The long-term trend and support was breaking for technology, e-commerce, cloud computing, all these companies, semiconductors in certain areas. And so what we noticed is those trends were breaking in terms of the weekly charts, in terms of the fundamentals, growth rates slowing. And so we started to allocate away from technology and towards some of the cheaper areas of the market that appear to be entering into a new long-term uptrend. Those sectors, financials, energy, commodities in general, industrials. So that's how we've been repositioning. So we can see here the chart on the left. This is energy plus financials as a percentage of overall global equities versus healthcare and tech. And we asked a simple question to all of our investors or prospects that are looking to invest: which of these do you want to buy and which of these do you want to sell? I'll allow you to answer that question, but for us, we certainly like where energy and financials are positioned from a long-term standpoint in terms of valuation, price, and of course, some of the trend changes, some of the overall quantitative trend changes that are beginning to take place at the sector level. Here, we can see the long-term return of tech versus energy since 2010. Energy is slightly negative over the last 10 years, while technology is up 900%. So we ask a simple question again. Do you want to buy a sector that's up 900% already, knowing that most sectors through stock market history have a tendency to run between 10 and 12 years when in a secular uptrend? Or do you want to buy a cheap sector that's down over the last 10 years, that's generating record free cash flow and has low valuations? We choose the latter. We choose to be invested in energy versus tech at this standpoint because it has more attractive prices. And that doesn't necessarily mean over the next 2 or 3 weeks, but we're looking over the next year, 2 years, 3 years. And that's how we think we can generate significant outperformance versus the market. Now, we talked about index concentration. One thing we've seen that is very peculiar to this particular cycle is that the biggest companies are now making up a vast record of the overall index. So back in 2000, Microsoft, GE, Cisco, Intel, and Walmart were the largest companies. They made up around 18% of the index. Now, the 5 largest companies, which are all tech or e-commerce related, make up 25% of the overall stock market index. And remember what happened in 2000 when it peaked out, when it went parabolic like it's just gone here over the last 6 to 12 months. We had a very significant period of underperformance, both from an absolute standpoint and from a relative standpoint. From 2000 to 2010, if you invested in the index, you had a negative return. It was called the lost decade. Why is that? Because most of the index was tech and healthcare. And if you were in tech and healthcare, you didn't make money. If you were in commodities, you made a lot of money. So we got to stay focused on these long-term trend changes that impact the market. So with the 5 largest companies making up 25% and the 7 largest companies making up 30% of the index, which way do you think these stocks will go next? For us, we want to shift away from the index and focus on some of the more unloved and cheaper areas of the stock market that are generating significant free cash flow. And we see that with Amazon. So if we look at Amazon right now, the number of buy ratings across Wall Street is 55. The number of holds or sells, 0. Literally, every analyst is bullish on Amazon, not one bear. So we have a great company, but a bad price. No one is bearish, yet the stock underneath the hood is deteriorating. So if you had a portfolio that was largely made up of Amazon, you've significantly underperformed the market over the last year. Amazon's deteriorating, yet everyone's bullish. So these are things that we want to watch out for with the FANG. If we look at China's version of the FANG, we look at Alibaba, we look at Tencent, JD.com. These were the monolithic companies in China, the tech behemoths. They're down 60% since February. So the message here is that yes, things can happen. Yes, these stocks can go down. And by the way, all of these stocks are in the top 10 at the turn of the decade. And one of the things we know is that largest companies at the turn of every decade have a tendency to turn over. And then, of course, the importance of rates. You know, last week we talked about how TLT flows, in other words, long-term bond flows, were in that 95th percentile. Look what's happened since. We've had interest rates move from about 1.13% up to about 1.34%. What's also happened since that time period? The strategy has risen, the opportunity strategy has risen about 6.2%. Remember what we discussed, that when rates bottom, we're likely to see a significant rally in our strategy. Why? Because it's tied to growth expectations. When the 10-year interest rate increase is not tied to Fed policy, it's tied to growth expectations. So what do we want to see from the Fed tomorrow? Believe it or not, a more dovish Federal Reserve, in other words, a Federal Reserve that is less inclined to raise interest rates later versus sooner, you're likely to actually see a rise in the 10-year interest rate. Why is that? Why would not raising rates increase long-term rates? Because the market is worried about a policy error, raising rates too quickly. If you raise rates too quickly, the growth expectations long-term come down, and the 10-year interest rate is tied to growth expectations. So if growth expectations increase as a result of easy monetary policy, the 10-year interest rate goes up. And that's actually bad for technology, and that's good for more economically sensitive sectors such as the banks, industrials, oil and gas, commodities in general, excuse me, these types of sectors. So if the 10-year interest rate continues to go up, and technically this looks like a very good chart, that means growth expectations are increased, being driven by increasing growth expectations. So what benefits from more growth and higher rates? Well, let's take a look. First, we know that stocks with higher earnings sensitivity to the growth cycle, to the business cycle, are prime beneficiaries. Businesses that have revenue pricing that is tied to interest rates, right? So if you run a business and interest rates go up and your revenue goes up in correlation to that, you want higher rates. You know, insurance companies are a great example of that. Banks are a great example of that. Valuations are cheap relative to the stock market. In other words, as growth expectations sank, valuations got compressed. We saw that in our portfolio. But meanwhile, the fundamentals have continued to improve. We need an ignition to unlock the value of those shares. And that's what higher rates and higher growth expectations ultimately do. So what are the areas that benefit the most in this type of environment? The banks, industrials, consumer, oil and gas, and commodities. So the next question we want to ask is, well, what are the leaders in each of those sectors? And that gets us to our company spotlight. The first company we're looking at that we have a dominant position in our portfolio is Bank of America. And the reason why we want to do this, we want to give clients this notion that they're not investing in stocks, they're not investing in geopolitical developments, they're investing in companies. And these companies have business models. And the objectives of these business models is to generate cash for investors and increase the value of the business. And the key is, what price do we buy that business at? The same way you would ask yourself, what price am I going to buy that house at, right? Depends on the location, depends on school districts, all these things. And so we want to ask the same questions for the businesses that we invest in. So Bank of America right now is trading at 13 times earnings, 1.9 times tangible price to book. This is incredibly cheap when we look at other sectors. Right? To put this into perspective, Tesla trades at over 120 times earnings, over 300, 400 times trailing earnings. So these stocks are incredibly cheap. They have a dividend yield of 2%. And so how do banks make money? They borrow short and lend long. I'm going to ask every one of our viewers to go into their checking or savings account and look, how much is the bank paying you for your cash right now? For me, it's about 0.05%. What does that mean? That is a bank's raw resource cost, the cost of doing business, right? Their raw materials are your deposits. The same way a raw material for an energy company is oil and the cost of taking that oil out of the ground, or maybe with a consumer goods company, it's plastics and all the materials that go into it. For banks, it's the deposits in their bank. And it's what is the interest rate they pay to those deposit holders. That's their cost of capital. So at 0.05%, their cost of capital to their deposit holders is basically nothing. But when the long-term interest rate rises, that's what's tied to mortgage rates. That's what's tied to consumer loans. That's how banks make money. So when the long-term rate goes up and the short-term rate stays low, banks make more money. That's why we're invested in Bank of America. That's why we're invested in Citigroup. That's why we like the banks here, because in a rising interest rate environment, they make more money. Oh, and by the way, they're really cheap at 13 times earnings. Google's a great company, but trades north of 25 times earnings. Microsoft's a great company, but trades north of 25 times earnings. Tesla's a great company, but trades over 100 times earnings. So we have to consider all these facts when we are trying to understand why do we own these companies and how confident can we be owning it through turbulent times, such as the months of June and July. What's another growth beneficiary? Energy, right? So if we look at the energy sector from a very short-term standpoint, the percentage of stocks at 3-month lows hit 82% last week. And remember what we said during last week's update. When we get this type of condition, it's usually emblematic of some sort of tradable low. And sure enough, Thursday was that tradable low. And we think that's a very well-established low. Of course, we can be wrong, but we think this is a very well-established low. We saw that back here in March of 2020. We saw it again in fall of last year before the big rally. And we go throughout history, all these low points are marked by these big spikes in 3-month lows. So I think that's a very good sign here as we head into the Fed tomorrow. And of course, as we head into the month of September, where the news cycle is going to pick up here quite a bit. But then secondly, if we look at the chart, we also see that energy did recapture that 200-day moving average, bit of a head fake on the 200-day moving average, broke down, then went right back up, back into positive trend. That's a good sign. So one of the companies that we own, I know we talked about Schlumberger and Occidental last week. One of the other companies that we own is ELG Resources. They're the biggest operator in the Eagle Ford down in South Texas. What do these guys do? Quite simply, they drill oil in the shale. They look for production of natural gas and crude oil, mostly crude oil. Natural gas tends to be sort of just a derivative of taking that oil out of the Eagle Ford shale. And what we love about this company is just how cheap this company is. It's trading at 8.87 times forward earnings versus, again, Tesla at 132 times earnings. And by the way, it also pays you a 2.5% dividend yield to sit and wait for that growth to be realized in the share price. We look at the financials of ELG Resources. Yes, COVID has introduced fear, is that growth rates will come down, right? That's fine. We just want to own good companies. And while COVID has introduced some short-term fear over the last 2 months, ELG has just become cheaper and is making more money while we can still buy the shares at a 37.6% discount versus its price in 2017. So what do we notice? In 2017, the company was worth $62.4 billion. Today, it's worth $39.19 billion. So what's changed from 2017 to today? Well, its revenue back in 2017 was $11.28 billion. Today, close to $14 billion of revenue. Okay, Rob, that's great, but maybe they're not generating as much free cash flow. Maybe there's something going on in the net margin picture to dilute that free cash flow. Let's take a look at that. In 2017, $141 million of free cash flow, then $1.7 billion of free cash flow in 2018. This year, it's expected the company will generate close to $4.4 billion of free cash flow. This is why we own ELG Resources and why we don't own Tesla. Because we want $4.4 billion of free cash flow as a shareholder at 8.8 times earnings. Cheap price, high free cash flow, great management team, great location in terms of where their wells at, premier land holdings in the Eagle Ford. That is why we own ELG Resources. We think that at $39.18 billion market cap, that this company is worth more than it was back in 2017. So you can do the math in terms of the return upside potential if we're proven correct on the fundamentals and how those fundamentals get reflected in price. So overall, to wrap things up, growth expectations are starting to recover as COVID cases begin to plateau. It's why we saw that 6% increase in the value of our strategies this week. Where do we see that continuing? Well, we want to make sure that COVID is continuing to plateau across more and more states. So far, showing signs of peaking across 9 states. Growth expectations, if they do continue to recover, generally speaking, good for energy, banks, and industrial stocks, commodities as a whole. So in the very short term here, we are broadcasting or recording this on Thursday. Tomorrow is Jackson Hole. We want to see what the Federal Reserve says. We want to make sure there's no room for policy error. So that's going to be important. And then, of course, the jobs report next week. All of these things are important to reset the growth expectations picture. And remember, it's growth expectations, not actual growth. So actual growth looks great. Now we need to get growth expectations, the psychology of the market, back on our side. And I think we saw a good and important first step this week. We have a lot of work to do, but you got to start with the first step, and we took an important first step this week. And we can also see that when things turn, they do turn quite violently to the upside, the same way as they do to the downside. And if we continue down this path, we think that we'll be able to recover quite rapidly. So thank you again for all your patience, your loyalty, and of course, all your great questions that you've been, all of our clients and advisors have been submitting week to week. If anyone has any questions or concerns, please feel free to reach out to your advisor, or you can reach out to us here at LifePro at 888-543-3776. Thank you again for all of your time, and have an absolutely fantastic weekend. Thank you.